Welcome to the Oanda Market Pulse Morning Market Snapshot. My name's Craig Erlam, Senior Market Analyst at Oanda. Now, we'll start with the economic calendar, and as you can see, there's a massive focus today on the US. We do have the UK autumn forecast statement, but I'm not anticipating that this is going to have any significant impact on the markets, if any at all. This does tend to just be a case nowadays of the Chancellor taking with one hand and giving with the other. So market impact tends to be quite slim in terms of the broader markets. Of course, if we're talking maybe individual stocks, it can have a bigger impact, but overall in the markets, it does tend to be quite slim. The key focus today is very clearly all of this US data. Now, there's so much data out that it's going to be difficult really for the markets, I feel, once the data is released, to truly determine what the market impact is going to be. Now, there's a lot of data released at 1:30, personal consumption expenditure price index. This is the Fed's preferred measure of inflation. It's expected to remain at 1.3% as it was last month. We've got personal income, personal spending figures. These are very good gauges of future price inflation. Of course, if people are earning more money, then the company is going to pass off those price increases, those cost increases to the end consumer, or more than likely so. So these are good indicators of future price inflation, which in reality is what the Fed is really focused on now. The Fed knows that the current inflation is low. They know that it's likely to be transitory, largely due to these lower energy prices, and therefore it's looking for indications that future price inflation is going to pick up back towards the 2% target level. We've also got other data as well, like durable goods orders, also due at 1:30. This is a lot of economic data all due at 1:30, alongside initial jobless claims. Now, the durable goods orders is a very important economic indicator for the US, because it really highlights two things. One is it highlights current spending, or current spending on large items that are expected to last 3 years or longer. So this is big machinery orders, big orders for computers or cars in terms of household consumers. Now, the reason why this is so important is, one, if people are spending more money now, then they obviously feel fairly well off. But also, if they're investing in these larger goods, then it means that they are confident in the economic outlook, and they're not fearing spending these large amounts of money on these longer term items. So this is both a current indicator, but also a good forward looking indicator as well, and that's why I tend to pay a lot of attention to the durable goods orders, but also why the market tends to react quite strongly to it as well. And it's important again because we've had 2 negative months here, which is again raised these fears of the outlook for the US economy. If people aren't spending big money, then are they really confident in the outlook? And if they're not confident in the outlook, then that will tend to weigh on the economy going forward. Now, we also have other pieces of data as well, which are probably going to not be in the spotlight quite as much this today, but really they are very important pieces of data. Things like new home sales, the market services PMI, the services sector accounts for more than 3/4 of the US economy. It's a good forward-looking indicator, and if we see big changes here, big improvements here, then that would suggest the outlook again is very positive in terms of the services sector. So these are important pieces of data, but they may just take a bit of a backseat today to the fact that we've to these inflation figures, income and spending figures, maybe durable goods orders as well. So there's a lot of data out. I do expect the markets to be very active as a result, but what I would say is a lot of this data is out at 1:30. It's going to be very difficult for the market to take all of this data in and respond accordingly. So what we may see just after these releases is a lot of volatility before the markets start to find their way. Now, speaking of the markets, let's take a look at them, and a couple that I just wanted to highlight here. And I think first things first I need to highlight is the fact that, given the fact that we're going to see a lot of volatility in all these dollar pairs, and also in things like gold, which again is heavily impacted by the dollar, commodities as a whole, we could see some big moves off the back of this data, which is hard to really anticipate from a technical perspective. What we can gauge from a technical perspective is what people are anticipating, but of course people's anticipations aren't always correct. What I will highlight is things like euro dollar, because again we are seeing a move to the downside, 106 being tested. It's fallen as low as 105.80 today, but we aren't again making new lows. Now, why I believe this is important is because again of this bullish divergence. We keep making these new lows, but momentum is severely lacking from these moves, and again with today we are seeing signs of this divergence. Now, what I found interesting on Monday was the fact that we made new lows on lower momentum, but also the lows we made were only 20 pips or so below the prior lows before we started to see some move to the upside. That suggests that this level is well supported, and again we are seeing selling today, and we've fallen back to 105.80, only around 10 pips below Monday's lows. it'll be interesting to see if these levels are well supported again, because if they are, it would suggest that we have found, temporarily at least, the lower end of the range. But again, it's very important to note that we've got a lot of US data on today, and if the US data is positive, then that could be enough to move it back towards these 104.50 to 105 levels, and I would anticipate that then we then see an end to this bullish divergence. Another one I wanted to highlight is the Australian dollar against the US dollar, because we had this long-term descending channel. I highlighted this in yesterday's video, and we said that the break of this was quite bullish, but I wasn't overly getting carried away with it at this stage, because we didn't see a big build of momentum after this move. Sometimes when you can see such a long-term resistance level broken, you can see a significant move to the upside off it, seeing things like stop orders, etc., being taken out. But just the bullishness that this signal sends to the market, if we've seen such a big level broken, then that would suggest the market's bullish and people can sometimes get on top of that. Instead, we saw a pullback back into the descending channel, and yes, we saw it close above, but really that is not a strong bullish signal. What we've seen today, though, or what we saw yesterday, was we saw a move back above Friday's highs, which was the first thing that I said I wanted to see in order to become more bullish on this. The next thing I'd like to see is a weekly close above this 21-week simple moving average, simply because it's been a key level of resistance on a number of occasions over the last 6 months. Now, of course, we're only on Wednesday, so we're not going to see that for a couple more days. The early signs are there that this may be a broader move to the upside, but what makes me again quite cautious is the fact that I do believe that the dollar could be strong for the next few weeks as we approach this Fed meeting and it starts to become increasingly priced in. Equally, while the Australian Central Bank, the Reserve Bank of Australia, haven't been quite as dovish as they have been in recent months, this shouldn't really bring too much strength to the Australian dollar, because I think they are widely anticipated to actually cut interest rates at least once or twice next year. But given the fact that we've broken above this descending channel, we can't ignore it, and if we see data not lead to too much dollar strength today, then we could see these 73.80 to 74.30 levels targeted. 38.2% retracement of the move from the May 14th highs to the September 4th lows. Beyond here, I think 75.30 to 76 will be very key. Previous levels of support, but also the 50% retracement of that same move. And at this point, we'd also have the 233-day simple moving average, potentially providing additional resistance here as well. For more in-depth news and analysis, check out Oanda MarketPulse at MarketPulse.com. You can also find out more about Oanda and sign up for a free demo account at Oanda.com. Here you'll also get access to Oanda Forex Labs, which has a lot of great tools aimed at helping you in your trading.